Good morning and thank you for joining us. I'm Matthew Lipman, CEO of Capstone Holding Corp, ticker CAPS, listed on Nasdaq. Capstone is a building products distribution platform serving North America with stone, masonry, and hardscape products. Today's presentation covers our 2025 results, our goals for 2026, and the financial performance of the platform. Capstone is built to deliver, positioned to acquire, and ready to scale. Today's content is fully qualified by the legal disclosures in the appendix. Our goal is to share the strategic thinking and financial analysis guiding the business, consistent with our principles of being accountable and transparent with shareholders. We operate in a hyper-dynamic economic environment. What we share is based on our best estimates and assumptions, and we reserve the right to revise our point of view as conditions change. Despite that uncertainty, we have to plan and make decisions. This presentation lays some of that out for your review. 3 sections today. First, a 2025 recap focused on execution and growth. Second, Capstone's goals for 2026, our key focus areas, the fiscal year 2026 budget, and the outlook. Third, a walk through the financial performance and our non-GAAP reporting. 2025 was a transformational year. We uplisted to Nasdaq in March, closed Carolina Stone in August, and closed Canadian Stone Industries, or CSI, in December. Capstone went from a single-subsidiary, 4-location distributor to a 3-subsidiary, 9-location platform spanning 38 U.S. states and Canada, with over 1,000 active customers and roughly $68 million of pro forma revenue. Setting expectations against reality. On interest rates, we planned for roughly 100 basis points of cuts and got about 50, and they came later than forecast, pushing demand recovery into 2026. Tariffs were an unforecasted headwind. Policy uncertainty drove customer hesitation and project delays across the year. Construction demand split regionally. Demand was delayed, not canceled. The Southeast outperformed, the Northeast and Midwest lagged. Even with that backdrop, the operating wins were real. 2 subsidiaries added. Carolina Stone gave us our entry into the Southeast. CSI made us a Canadian market leader and filled out the North American footprint. Revenue grew 4.5% year over year. That growth was acquisition-led. Legacy organic revenue declined modestly with delayed rate cuts and tariff uncertainty. And Carolina Stone contributed 4 months at a slower season, while CSI contributed 1 month off-season. Both headwinds reverse in 2026. Full-year acquisition contribution layers in, and organic recovery is positioned to follow as the cycle improves, particularly in the South. Gross profit grew 12.8%, well ahead of revenue. That is structural, from sourcing improvement and a stronger product mix, not just volume leverage. Gross margin expanded 170 basis points, from 21.3% to 23%. The owned brand mix is rising, and that shift is structural, not cyclical. Carolina Stone closed in August, about $11 million of revenue, at roughly 4.7 to 5.2 times EBITDA. It is our Southeast entry, anchored in the Triangle and Charlotte metros, and it adds higher margin installation and value-added services. CSI closed in December, about $15 million of revenue acquired at book value. CSI is the Canadian market leader and gives us a single point of entry for any manufacturer wanting U.S. and Canadian coverage. Our integration playbook proved itself. We went live on day 1 at CSI with full ERP visibility from close. The pipeline remains active, 150-plus targets with the Southeast and Pacific Northwest prioritized. 4 new locations took us from 5 to 9 coast to coast. We now serve 38 U.S. states and Canada. Carolina Stone added 2 locations in the Southeast. CSI added 3 locations across Canada, with a California foothold that gives us West Coast presence. Capstone has transitioned from a regional operator to a North American building products platform. 5 wins worth highlighting. Rapid integration, what peers take 60 days to do, we did on day 1 at CSI. That playbook is repeatable for every future deal. Brand portfolio, 6 premium brands across price points with national and regional coverage and dealer pull-through driving cross-sell. Margin expansion. Gross margin from 21.3% to 23% with COVID-era inventory fully cleared. The owned brand mix shift is structural. M&A pipeline. Over 150 targets identified at 4 to 6 times EBITDA, with SG&A held at run rate so deployment stays disciplined. AI initiative, external consultants engaged, an AI-powered pricing engine in development with rollout targeted for the second half of 2026. We are executing with discipline and positioned to scale in 2026. We turn now to 2026, our outlook, our plans, and the budget. We are calling 2026 our year of execution. 4 focus areas: new products, targeting high-growth segments; new geography, or entering the Pacific Northwest and expanding the Southeast; facilities, consolidating into more efficient hubs; and AI transformation, in full swing across the company. Together, these give us a clear path to $100 million plus in revenue, with margin expansion, a scalable platform, and multiple growth levers. 4 points on how we enter the year. Strategic initiatives are already underway across operations, new product launches, and geographic expansion. The platform is stronger, greater scale, broader reach, deeper integration. The path to a $100 million plus run rate is supported by owned brand growth, logistics efficiency, and cost discipline, and we are positioned to capture upside as end market conditions improve. 2026 is the first full year with all 3 subsidiaries in the numbers, and it is where the platform starts paying off for CAPS shareholders. Combined Stone business revenue steps from $46.9 million in 2025 to $72.1 million in 2026, a 54% increase. Gross profit nearly doubles to $18.7 million. Gross margin expands 300 basis points to 26%. Adjusted EBITDA grows nearly fourfold, from $987,000 to $3.8 million. The adjusted EBITDA margin sequence tells the story. 2.5% in 2024, 2.1% in 2025, reflecting integration drag from the partial year stubs, and 5.2% targeted for 2026. 3 drivers carry that step up. First, the full year contribution from Carolina Stone and CSI, both businesses producing for 12 months instead of partial stubs at off-season. Second, gross margin expansion to 26% as the owned brand mix rises and sourcing leverage compounds. Third, SG&A leverage as the run rate cost base absorbs the higher revenue. Greater product breadth and new geography drive the result. We are expanding the brand lineup, building toward the broadest natural and manufactured stone portfolio in North America. 2 new brand launches in the first half of the year. Eldorado Stone in April, Nature's Edge in the second quarter. Both leverage our fixed cost infrastructure to support higher margins. On the CSI product pipeline, Flex Brick, a thin brick alternative for interiors. Aura Stone, a premium manufactured line, and Nature's Edge Canada, a cross-border launch leveraging CSI manufacturing for U.S. distribution. 2 new product lines launching in the first half of 2026 expand our owned brand revenue mix. Coast-to-coast coverage by year-end. Pacific Northwest expansion is the West Coast play. NorCal and PNW build-out, local sales a distribution hub to close the West Coast coverage gap. Southeast sales expansion makes Carolina Stone the regional hub, expanded sales force, white space mapping for new opportunities, and a target of 10+ locations by year-end. PNW and SE are our highest priority expansion corridors for 2026. Optimize and consolidate. We have identified $480,000 of annual savings. We are consolidating the All-Sip, Illinois facility into Navarre, Ohio. That eliminates duplicate overhead, optimizes freight routes, improves fixed cost absorption, and centralizes inventory at a single hub. The expected impact is $480,000 of annual savings. Immediate P&L benefit from rent and overhead elimination, freight cost reduction through route optimization, better fixed cost absorption at higher throughput, and a scalable platform for future volume. 1 Midwest facility, 1 team, 1 platform. We are deploying AI across 5 operational areas with measurable cost reduction targets by the end of 2026. On the team and infrastructure side, a dedicated AI team with new hires, external consultants, a real data architecture and integration layer, and initial launches already in progress. Automation targets cover purchasing, inventory, routing, finance, and lead generation. AI-driven procurement, demand forecasting, logistics optimization, and pipeline automation. This is operating leverage in building products, not a buzzword. Our planning assumptions are execution-driven. We are not relying on a broad macro recovery to hit the budget. Rate relief is upside, not the plan. On rates, we expect the environment to be more supportive in 2026 than it was in 2025. On Canada, near-term conditions are soft. We expect improvement in the second half. Housing and repair and remodel demand should improve gradually, not rebound sharply. The continuing housing undersupply supports longer-term sector demand. Pipeline scale. Over 150 identified targets, with valuations remaining attractive at 4 to 6 times EBITDA, supported by realistic seller expectations. Active engagement across regional distributors and niche product specialists. Relationships are being nurtured. Near-term focus is on demonstrating the earnings power of the integrated platform. Transaction timing will be evaluated as 2026 results mature. Deal discipline is non-negotiable. Every future deal must be accretive, disciplined, and compound per share value. 3-pronged, tuck-in acquisitions, sister companies, and platform acquisitions. Capstone is capitalizing on a favorable deal environment. Attractive valuations at 4 to 6 times EBITDA. Flexible consideration with 20 to 45% non-cash, and strong execution confidence with pricing and structure consistent with our expectations. We turn now to the financials. The stone business first, then the parent. The stone business includes Instone for the full year, Carolina Stone from August 22nd, and Canadian Stone Industries from December 1st. Revenue grew 4.5% from $44.9 million to $46.9 million. Gross profit grew 12.8% to $10.8 million. Gross margin expanded 170 basis points to 23%. SG&A increased to $9.8 million as the new businesses came on. The SG&A figure excludes one-time items called out in the table footnote: ERP implementation, acquisition costs, a legal amendment, other non-recurring items, and the $6.2 million goodwill impairment. Adjusted EBITDA was $987,000 for the year, compared with $1,124,000 in 2024, a modest decline that reflects integration drag from acquisitions, contributing only partial year off-season revenue. That drag does not repeat. The full-year benefit shows up in 2026, as we walked through on slide 13. After management fees and Instone board fees, Stone business net loss on a non-GAAP basis was $2.1 million. With the Class B preferred return, comprehensive loss was $2.8 million. Two views of corporate costs: relatively fixed, full-time employees, corporate acquisition costs, legal and insurance, board fees, and other public company and financing costs. Variable, investor relations, IR, PR, and marketing, all of which we can adjust as required. Two items worth flagging in 2025. Investor relations expense of $1.1 million is non-recurring. Acquisition-related expense of $1 million reflects the M&A activity completed during the year. When valuing the business, corporate overhead, Capstone and Brookstone management fees, and board fees are non-essential to the operating subsidiaries. Those costs are excluded when valuing Instone, Carolina Stone, and CSI. Capstone standalone, the parent, does not generate revenue. SG&A stepped up to $3.2 million in 2025. Driven by the non-recurring investor relations spend, IPO-related Instone fees, compensation, and financial services costs. Capstone standalone net loss on a non-GAAP basis was $6.5 million. Two FY 2025 items are excluded from this view, both non-cash. First, a $7.2 million increase in the deferred tax asset valuation allowance. That is an accounting judgment. Auditors apply conservatism to NOL utilization until platform profitability is established. It is not a cash tax cost, and we expect to release the allowance as the platform scales into profitability. Second, a $0.8 million unrealized gain on a derivative, mark-to-market accounting, not part of operating performance. Both items appear in the GAAP to non-GAAP reconciliation in the appendix. Integration is complete. Growth is accelerating. CAPS enters 2026 stronger, leaner, and ready to scale. Rate relief is starting to fuel housing and renovation demand. Integration is done. Owned brands are scaling, new ones are coming. The platform is built, the playbook is proven, and the business is built to compound. Margin expansion is coming from sourcing, logistics, and mix. The platform is ready for sustained growth and cash generation. Pro forma 2025 revenue of approximately $68 million ramps to a $72 million budget for 2026, with a $100 million plus run rate target as the platform matures. Adjusted EBITDA grows nearly fourfold in 2026, from $987,000 to $3.8 million. 6 dated catalysts to watch through 2026. Q1 2026 earnings in May. The first quarter with all 3 subsidiaries in the run rate, the Eldorado Stone product launch in April, the Nature's Edge launch in the second quarter, the Alsip to Navarre consolidation through the third quarter with $480,000 of identified annual savings, the annual stockholder meeting on June 18th, and M&A pipeline activity continuing through the year against our 4 to 6 times EBITDA discipline. 3 principles guide how we deliver long-term value. Transparency, a clear view into performance builds trust. Accountability, it enables performance management and ownership. Adaptability, we expect to update our range every quarter as the year moves forward. Capstone Holding Corporation, Nasdaq, ticker CAPS. Thank you for your time. For more information, please reach out at investors@capstoneholdingcorp.com. The following pages include the GAAP reconciliation, our non-GAAP definitions, and the full legal disclosure. The full GAAP to non-GAAP walk. Capstone consolidated GAAP net loss was $21.9 million in 2025 versus $2.6 million in 2024. We remove Capstone parent expenses, the $7.2 million deferred tax valuation, $2.3 million of interest, $3.2 million of SG&A, $1 million of other expense, and the $0.8 million unrealized derivative gain. We also remove the $6.2 million Instone goodwill impairment. That brings us to Stone business net loss of $2.8 million on a non-GAAP basis. We then add back management fees, in-stone board fees, the Class B preferred return, taxes, interest, other expense, and depreciation and amortization to arrive at adjusted stone business EBITDA of $987,000 for 2025 versus $1,124,000 for 2024. Capstone uses non-GAAP adjusted EBITDA as a supplemental measure of performance. It is not a substitute for GAAP measures, and other companies may define it differently. We use it because it lets us compare operating performance consistently period over period and isolate the trends affecting the business. The full definition is included on this page. The full legal disclosure is included on this page. Please review. The legal disclosure continues. Please review. Capstone Holding Corporation, Nasdaq CAPS. Growth is just getting started. Learn more at www.capstoneholdingcorp.com. Thank you.